Today we're going to talk about Google and their upcoming earnings. We'll go over the numbers that analysts are expecting them to announce. We'll also take a look at their valuation and compare it to one of their closest competitors. And finally, we'll discuss the metric that will matter the most for Google and their ability to grow their stock price. So if you enjoyed the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. So far, year to date, Google is up almost 13%, and in the course of the last year, the stock has moved up almost 50%, and it gets even better when we look at the last 5 years, with the stock moving up almost 150%. Most investors are looking for companies that are going to outperform the broader market or the S&P 500, and so far year to date, the S&P 500 is up only 6.5%. Over the course of the last year, it's up 20%, and over the course of the last 5 years, it's up 70%, and Google has outperformed the S&P 500 on all three of these time frames. And not only is this true for the S&P 500, but they have also outperformed the NASDAQ. The NASDAQ year to date is up 5%. Over the course of the last year, it's up 32%. And over the course of the last 5 years, it's up 122%. And part of the reason for this outperformance is due to strong numbers that they put up quarter after quarter. We can see that of the last 4 quarters, they have beat every quarter on both their EPS and their revenue. And Google is set to report their numbers on April 25th for their current quarter, and they're expected to report an EPS of $1.50 and a revenue of $78.68 billion. And on Yahoo Finance, they have an average EPS estimate of $1.42, a low estimate of $1.27, and a high estimate of $1.56. And even though this average EPS estimate is lower than what we saw on Google, it is still tremendous growth year over year from $1.17 that they put up a year prior. This is about 21% growth in earnings per share year over year. And Yahoo Finance has a fairly low revenue estimate as well, sitting at $73.97 billion. This is only 6% growth year over year. Personally, I think they'll put up revenue numbers anywhere from $75 to $78 billion. This would put their year over year growth anywhere from 7 to 12%. And that growth rate would be much more in line with what we've seen over the last few quarters of 7%, 11%, and 13% growth in terms of their top line year over year. We can see that Google over the last 5 years has actually grown their revenue from $142 billion all the way up to $307 billion for the trailing 12-month period. And most of this growth comes in a year-and-a-half period spanning through 2021 and half of 2022. But Google has also done a very good job of maintaining these numbers and actually getting back to growth in the last couple of quarters. And this trend is fairly true for Google's EPS as well. They did experience some negative growth in 2022 into 2023, a lot of this having to do with higher inflation numbers and increasing interest rates. A lot of advertisers during this time were looking to pull back on some of their ad spend, and this obviously had a big effect on Google. However, when we go back 5 years ago, we can see that Google was bringing in a trailing 12-month EPS of $2. That has since grown all the way to $5.80, which is the highest we have ever seen, even higher than their peak back in 2021 of $5.61. Part of the reason that Google has such strong revenue and EPS numbers is the fact that they have an absolutely massive market share when it comes to search engines. This number specifically is their mobile search engines, where they have 95% market share. This gives Google a couple of different benefits. The first being the fact that they have more pricing power due to the fact that they have such a large market share. Everyone who is going online and looking something up is using Google, and because of that, advertisers have to be on Google and using them to display their ads. The second benefit is the fact that so many people are using Google, they can better target those audiences and improve their customer experiences, helping these companies find the people who are actually going to purchase from them. The only drawdown to Google's business model is that they are not very diversified. They are very dependent on ad spend, and we saw this in 2022 2022 and 2023, where earnings began to drop because a lot of these advertisers were pulling back on some of their spend. Even though Google has a very strong business model, they do tend to lag behind a lot of other big tech companies in terms of their valuation. Google's current forward P/E ratio is sitting at a 23.09. The best company to compare Google to is Meta, because both of these two companies rely heavily on advertising dollars. And for Meta, their forward P/E ratio is currently sitting at a 24.45, so slightly higher than where Google is at. And in terms of valuation, both of these companies trail a company like Apple, which is currently sitting at a forward P/E ratio of a 25.77. But keep in mind, Apple has dropped significantly in the last couple of months. Just a few months ago, it was trading at a forward P/E ratio of 29.15. And we can see that that's been fairly consistent over the course of the last year. And when we compare Google against itself, it's currently trading at the middle of its range, trading at a trailing P/E ratio of about a 27.05. Over time, especially the last 5 years, it's basically traded in a range anywhere from a 20 all the way up to about a 30 P/E ratio. So the reason I show all these P/E ratio numbers is to show the fact that Google is basically trading at a fair valuation compared to where it has historically traded. When we see Google trading up in the 30 range, that generally has to do with valuation shifts in the market where interest rates are low and people tend to have more money that they're putting into the market. However, when Google traded down to that 19-ish number, that had to do with the fact that we were seeing a little bit of trouble from Google in terms of their EPS falling, as well as concerns around AI and them falling behind. However, we're likely not going to see big shifts in Google's valuation based off what we are currently seeing from the market, because it is trading in such a middle ground right now. So what that ultimately means for investors is they need to be banking on Google growing their EPS and growing their free cash flow. And Google has done a very good job of this over the course of the last 8 or so years. We can see back in 2016, they were bringing in $26 billion of free cash flow. That number has since grown all the way up to $69.5 billion of free cash flow. This equates to a free cash flow growth of about 15% each year. So personally, when I am watching Google's earnings here in a week or so, I'm going to be paying attention to their EPS numbers specifically. I want to see them putting up a number anywhere from $1.42 all the way up to $1.50. That would be ideal from Google to show that they are continuing to grow their EPS numbers quarter after quarter, which will not only help with their valuation, but also help grow the stock price over time. Along with solid EPS numbers, I do want to see them buy back and continue to buy back shares. This will help reduce their shares outstanding and increase shareholder value. Back around 5 years ago, they were sitting at 15 billion shares outstanding. That number has since decreased down to about 13.6 billion shares outstanding. And they've been decreasing shares outstanding by around 3% year over year, which is a fairly solid number for a lot of these bigger companies where they're buying back around 2 to 3% of their shares each year. So keep in mind, I do own shares of Google, and really the reason I love this company so much is because of the monopoly that they have over the search engine business. When you think of a monopoly, this allows them to have pricing power over a lot of their customers, as I mentioned earlier. And a lot of these big tech companies that have seen a massive amount of success have really established their own niche monopolies within tech. When you think of Apple or Amazon or Meta or Google, they all have built out a very strong market share within tech that allows them for pricing power and really building out an ecosystem that keeps customers using their products. And this is also true for Alphabet, and that is why I like their company. But do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So with all of that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, why couldn't the tree get on his computer? Check the comments down below for the answer. Thanks for watching, guys.